So what's been all over the news lately, and it's tariffs. So there's really two things I want to talk about today. The first, of course, tariffs, and the second thing, inflation, which we talked a lot about. But now that tariffs have really become a centerpiece of conversation amongst a lot of us, myself, clients, friends, family, the news, I think tariffs and inflation really go hand in hand together. So let's dive right in. So under the Trump administration, everybody's basically familiar at this point that Trump wants to impose tariffs on other countries. He's talked about imposing tariffs and has imposed tariffs on Mexico, Canada, and mainly China. And he's also talked about imposing tariffs on other countries in Europe and other countries in Asia as well. So he has a very aggressive stance towards tariffs. And taking the personal aspect out of it, let's talk about what this actually means and how this will reflect the economies and, more importantly, our stock investment portfolios. So tariffs, all they are, they're a tax on goods that are imported into the country from other countries or other companies doing business outside of this country. It could even be imports on companies that are also located in the United States, but have other facilities overseas. Think like NVIDIA, for an example. NVIDIA is a company many people are familiar with, and they produce a lot of their chips overseas. And those chips, when they're imported, they'll have an additional tax imposed. So these additional taxes, what they're doing is they are, they're putting stressors on companies doing business overseas. This can hurt profitabilities and corporate margins at the end of the day. On the flip side, they will reward companies that are based in the United States. They will encourage companies to do more business internally and really make the United States less dependent on other countries to bring in goods and services, because there's no tax on producing those goods and services here at home on domestic soil. So what that also means is that this could create some tensions between relationships, and we're going to talk a little bit about what that means with inflation in a moment. But the big thing about tariffs is that they are really used to generate additional revenue for the U.S. Treasury Department. That's one of the most important reasons behind tariffs. And the U.S. has a terrible deficit at the moment. We're in the trillions of dollars, and the Trump administration knows that the tax law changes are due to sunset at the end of 2025. And it's somewhat likely that they will be able to extend these tax laws. But even if they don't get extended, what's going to happen there is the Treasury deficit situation is really going to remain relatively unchanged. And I think what the Trump administration is trying to do is they're looking to generate revenue elsewhere while not having to punish, quote unquote, American citizens to foot the bill, right? It really is the government's fault that the deficit is so high. They're in control of the spending, and they are looking to fill some of those gaps from overseas sources versus footing the bill for American citizens to pay. So that's really one of the big reasons behind tariffs. And I'm giving somewhat of a very high level 30,000 foot view. Tariffs go much deeper than what we're talking about in this video. My job and what I want to do is just educate folks on really what tariffs mean, how they work, and then some of the overall implications and why the government is imposing tariffs versus doing something else, right? So, of course, tariffs, what they're going to do is, they might hurt international stocks when it comes to our portfolios. Maybe international stocks might not do as well. Some U.S. companies may not do as well, especially if they're doing business overseas. But with that in mind, earnings still look very, very strong for U.S. companies. Analyst estimates throughout the remainder of this year, we're going to be in the midst of earnings season for Q4 of 2024. Last year, a lot of the numbers are going to be coming out now. And then the remainder of the year, all of the data looks really, really good. All of the S&P 500 companies, analyst estimates are estimated to be either in the high single digits or in the low double digits. So between like the 8 to 14% range, depending upon the quarter you're looking at. And that's really strong, considering the fact that inflation has persisted. We've had a lot of geopolitical issues outside of the tariffs, of course. We've had a new president come in with very aggressive policies, creating uncertainty in the markets, and the media reporting a lot of uncertainty there as well. So with that in mind, the U.S. stock market has proved to be extremely resilient despite everything else going on in the world. So let's talk about inflation a little bit and how that works with tariffs. So really, the Fed is trying to control rates as much as they can, and they wanted to be more aggressive with rate cuts this year, but it's not looking like they'll be able to just because inflation has persisted. And what's going to happen, and tariffs are a component of this. So when tariffs are flowing additional money into the U.S. Treasury Department, this can have some effect on Treasury yields and inflationary policies that the Fed is going to be looking at, right? Especially if countries decide to reduce their Treasury exposure. China, one of their forms of retaliation was actually to sell some of their U.S. Treasury portfolio. They are one of the United States' largest customers when it comes to buying U.S. Treasury bonds. And as a form of retaliation of the tariffs, they are offloading some of those bonds, which then just puts additional pressure on the Treasury to then go out and raise additional money. A lot of bonds are also set to mature this year in 2025 as well. So the Treasury is sort of scrambling to say, well, where can we raise additional capital? Where can we find investor money to have more money flow in? So that's becoming one of the challenges, but tariffs can actually relieve some of the pressure. It's somewhat of a catch-22, right? Because if we're imposing tariffs and then countries are saying, well, we're going to offload some of our bond portfolio in retaliation, it's like, is it really netting equal? And the answer is probably, right. It's hard to tell for certain what's actually happening, but the answer is probably. So we'll see what happens with tariffs and inflation. But really the main thing here too with inflation is not so much on the tariffs. I know I just made a point about it, but it's more so due to actually American citizens, because our incomes have gone up significantly. Our spending has increased significantly. The more and more access to technology that we have, the more and more likely it is to spend. I know for me personally, anytime that I need to buy something for my son, instead of running to the store, I just hop on Amazon or I hop on some other online shopping platform and I say, okay, he needs diapers. And then it's recommended, oh, do you want to get maybe a baby lotion with your diapers? Or do you need a new toothpaste for yourself? Or do you need this or that? And oftentimes I'm thinking to myself, I'm like, wow, I actually do need a few more of these items. And I end up spending more than I initially planned to, right? And of course that happens too. If any one of us have ever shopped at like Costco or BJ's, you go in there planning to spend $50 and you end up spending $500, right? So the same concept applies, especially with online shopping, but it's just become much more accessible. So again, I don't view this as a bad thing for the economy, but it can create some headwinds with inflation, right? Because if people are making more and spending more, it's going to encourage companies to continue to raise prices, right? Inflation is just raising prices. So if there's a good case for companies to continue to raise those prices, inflation is going to continue to persist and continue to stick around. And it makes the job on the Fed very, very challenging to be able to then say, well, should we reduce rates? And the answer is going to be no, we should not reduce rates because prices are still going up. So as long as the prices are staying relatively stable, then it will create a compelling argument for the Fed to keep rates the same or maybe even reduce them. If prices start to go up, then the Fed will maybe reposition their outlook and say, well, we may actually bump up rates, but I think that's very unlikely. But again, there's always that possibility. So that's why we talk about it and say what's likely, what's not likely. I think what's most likely is that the Fed will likely keep rates relatively the same throughout the year. I think a rate hike or a rate cut on both ends of the spectrum is pretty unlikely. I think the most likely scenario is they're going to keep everything status quo and just let the economy play out for at least the next 6 months. There might be talks of a rate cut at the tail end of the year, but that's too far in advance for us to really speculate. So I really just want to focus on the next 3 to 6 months, which brings us right into the early parts of summer, which is exciting because I'm ready to get out of this cold weather. So with that in mind, thank you so much for tuning in today. I know we talked about a lot between tariffs and inflation, but I felt like it was important to discuss these aspects with each and every one of you because it's been on the news. It's been a forefront of conversations with myself and a lot of clients are calling in and asking about it. So just wanted to take a little bit of a deeper dive today. So thank you so much for tuning in and I'll see everyone next week.